Hey, what's up, stock compounders? Brad here. So today I want to talk about how to sabotage your magic formula investing portfolio. This is a warning from Joel Greenblatt. So to give a little backstory, at the end of June, I started using the magic formula investing approach. I bought my first 5 magic formula stocks. And the way I did that, I made a video a few weeks ago about it, but I took the top 50 results for the magic formula, made a spreadsheet, and then I looked for which of those stocks were owned by super investors. That's super investors that are tracked by Dataroma, okay, dataroma.com. Because I thought, well, if I can narrow these options down to companies that these great investors have already vetted and purchased, that's probably going to improve my odds. So that was my kind of first filter. Then I narrowed those remaining stocks down by companies that had a value investors club write-up, okay? And then I further weeded it down by looking at insider ownership percentage. Because there was a book written called 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. And a big commonality between 100 baggers was high insider ownership or owner operators, where the people who are running that company have a lot of skin in the game. Their rewards are aligned with those of shareholders, okay? So anyway, that's how I set up my first 5 buys with the magic formula. A few days ago, I got a comment from Nikhil. I hope I'm saying that right. And Nikhil basically said, it makes sense that you're filtering stocks in this way, but I'm concerned that when you take the magic formula investing approach and you try to combine it with these other filters, you're actually diminishing your results, okay? And so I got curious about that. I was like, I was under the impression that, as long as we select from that magic formula list, we're going to get those results as long as we have 20 to 30 stocks in our portfolio. But he mentioned that Joel Greenblatt said something about this in his Google talk, all right? So I went back through and I watched the Google talk, and Greenblatt did say something about this. He said investors who try to pick individual companies within the magic formula screen do tend to do worse than companies that are picked, an approach where companies are picked at random, okay? So, and there's an article that he referenced in that talk. And I'm going to link that article in the description here so you can kind of follow through. As I go through it, it's a fascinating little write-up about this difference between, trying to intelligently select stocks within the magic formula versus, automatically generating them or randomly picking them. And the little write-up here is adding your 2 cents may cost a lot over the long term, okay? Like I said, I linked it in the description. So essentially, after Joel Greenblatt released this magic formula investing approach to the world, he did something very smart. So there was, what does he call it? He set up a way on the website where you can click professionally managed, okay? Which means the magic formula approach will be implemented for you, all right? Versus people who want to self-manage, people who want to, decide which of the stocks in the magic formula they buy, and then kind of decide when to sell those stocks as well. He found for all the self-managed accounts over a 2-year period, there was a cumulative return of 59.4%, okay? Which is great. That's almost 30% a year. Now, the downside here is the S&P 500 over that period was up 62.7%. So you would have done better over those 2 years just to have a passive stake in the S&P 500 index versus this magic formula approach. The interesting thing is that a compilation of the professionally managed accounts earned 84.1% over the same 2 years, which is, beating the self-managed by about 25%, which is significant. It's a huge difference, actually, he calls it. So, he wanted to know, why did the self-managed accounts lag behind the professionally managed accounts? And I think these professionally managed accounts were really just where, you set it up to run automatically. The stocks are picked at random. The buys and the sells happen as predetermined. If it's a winning stock, it's sold just after a year. If it's a losing stock, it's sold just before a year to have tax advantages. And it's all just set up, and there's no humans that are making any decisions about it. That's the professionally managed. So let's talk about why. Why did the self-managed underperform? So number one, self-managed investors avoided buying many of the biggest winners, okay? And here's why Joel Greenblatt thinks that happened. The market prices certain businesses cheaply for reasons that are usually very well known, okay? These businesses are out of favor, all right? And, if humans are looking at this list, it's going to be easier to pick out the businesses that are clearly out of favor in the news, or, it may even just be popularly known that these businesses, there are issues with them. It reminds me of Facebook during the whole Cambridge Analytica scandal, and it was, down to, I think it got down to like $130 something, $130 per share. And obviously you look at where it is now. Facebook was out of favor. So, even if Facebook might have shown up on a magic formula list, with all of this stuff going on, the scandal, out of favor, like, people are running away from Facebook. People are closing their Facebook accounts. So, an investor might have seen that in the list and automatically disqualified that, even though because it was so cheap, it had a much higher likelihood of doing very well, simply because it was so cheap. So that's the first thing. Self-managed investors with the magic formula portfolio, they're systematically avoiding those companies that are out of favor. So that's one. Number two, many self-managed investors changed their game plan after the strategy underperformed for a period of time. And this is really, this is so common in the stock market, guys. As your portfolio drops, as it seems like you're losing money, right? You stop buying. You start to think about, oh, what if I lose more money? Or, oh, it must be risky because the prices are going down, because it seems like I'm losing money. That's when people flee, right? And the same thing happens with the magic formula portfolio, when in reality that's actually the best time to double down, or at least stay in the game, at least continuing to execute your plan. So, he says here, it's hard to stick with a strategy that's not working for a little while. The biggest advantage we have as investors is to have patience, okay? It can take years. It can really take years for something that's undervalued, something that's a bargain, to be fully priced by the markets. Number three is related to number two. Change their game plan after the market and their self-managed portfolios declined. So you get like a market crash situation, a market decline. People tend to flee from their investments, pull money out when those things happen. And number four, many self-managed investors bought more after good periods of performance, okay? So this is the inverse of fleeing when stock prices are crashing. As stock prices are rising, people tend to get more aggressive with their investments, thinking the rising prices are affirming their investment decisions, that, oh, this must be a great investment because the price is going up. And of course, as the price goes up, your prospective returns actually go down as the price goes up in relation to the value of the stock. The long-term prospects are actually less attractive, and that's something that not many people, it's hard to understand that. It's hard to really internalize that. And this last piece is actually the most important piece to me. The best performing self-managed account didn't actually do anything, okay? What I mean is that after the initial account was opened, the client bought stocks from the list and never touched them again for the entire 2-year period. So in this case, it's 2 years isn't really a coffee can approach, but it's the coffee can kind of mentality where, you're buying these companies because they show promising potential as being good long-term investments, and then you forget about it. You let time, grow your wealth, grow your portfolio. So this is fascinating, and this is really something I'm trying to intelligently figure out how to incorporate into my magic formula portfolio. And the way I'm doing it now, the way I'm anticipating deciding when to sell companies is to wait until that super investor who also owns the stock, because remember, that's my first filter criteria. It must be owned by a super investor. To wait until that super investor sells that position, okay? So it's not going to be the 1 year kind of buy and sell that's recommended by the Magic Formula portfolio. And this is encouraging. This little piece here, the best performing self-managed account didn't do anything, okay? That really kind of affirms this idea of waiting longer than a year. 100 baggers take an average of 26 years to become 100 baggers, at least in the study that was done for Chris Meyer's book. Joel Greenblatt says it over and over again. The magic, the best advantage we have as investors is patience, doing less, okay? So I'm incorporating that ethos into my magic formula strategy by, waiting, not selling after a year, but waiting until, somebody much smarter than myself has decided, okay, it's time to part ways with this particular company, with this particular stock. So I'm so grateful for Nikhil, and I hope I'm pronouncing that right, for leaving that comment questioning whether it was actually productive for me to be trying to intelligently narrow down my magic formula stock selections using these additional criteria beyond earnings yield and return on invested capital that go into the magic formula. It's really given me a lot to think about, so really appreciate you, and hopefully you guys got something out of this. Let me know what you guys think of this little article that I linked and kind of discussed throughout this video. It's fascinating. But anyway, with that, I will leave you guys and see you in the next video. Take care.